today I am going to be talking about 5 simple steps for you to start investing as an investor in the UK. And now this could be applied to you regardless of your location. If you're in the US, if you're in Nigeria, these are 5 simple steps to aid you on becoming a new beginner investor and start your journey to building wealth and achieving financial freedom. Number one is, first off, you need to acquire some level of financial education and financial literacy. Something as simple as reading a blog post, following a Finsta account on Instagram, just going through the markets, following what are the popular stocks you've heard of? What are the popular companies you've heard of in the US stock market, the global stock market? Something as simple as Googling them, listening to the news surrounding the company, what the company is all about, can give you a better insight into what the financial market says. You could use platforms like Motley Fool, The Economist, to find up-to-date, relevant events about the market. Then number 2 will be, after you've acquired a little bit of financial education, now you know what financial education is, you know what it entails. So how are we going to start? Now you know what it entails. Then the next thing will be to budget your income. So when it comes to budgeting, the first thing you have to do will be to go through your account statement, just to, get a little bit of understanding about where your money is going. Where have you been spending your money all this time, all this month, all these years? You need to have an in-depth and proper understanding of where your money goes. That way you're able to restructure your finances and to know what is important for you to spend money on, what is not so important for you to spend money on. That way you're able to curtail your savings, your expenses. So now with the budgeting and we're going through your account, you now know what portion of your income you can allocate towards your investment account, what portion of your income you can allocate towards your savings account. So this is why budgeting and going through your account is super, super, super important. Then number 3 will be, now you've done the hard part, you've done the budgeting part. Now you need to look for a financial firm, an asset management firm, a financial platform. It could be Vanguard, it could be Fidelity, it could be Trading 212. You just need to search for the right asset management firm for you that will help you manage your money better. So now you search for those firms. You have to bear it in mind, their customer service. Do they have a good customer service? What are their fees like? What are their charges like? What type of accounts do they have? Can they cater for someone like you? This is because now you've known how much you want to put towards your account. Can they cater for someone like you? So when you found out like a financial platform, then you now have to create your own investment goals and your financial goals. And then you have to make sure that the financial platform that you've chosen or the asset management firm that you've chosen can help you achieve the goals, the investment goals and the financial goals that you have set for yourself and for your money, right? So you have to set these goals and put them on paper. Usually you have to set goals. So it's usually advisable that you set longer term goals, let's say a 5-year investment goals, because trust me, investment is long term. So your investment goals usually include the time horizon, the type of investments you want, your risk profile. So are you a high risk investor? If you lose your money, would you cry? Will you die? Will you jump inside the lagoon? Will it affect the way you live? So if you lose a certain percent of your money, how will it affect you? If you lose 50% of your capital, how will it affect you? How will it affect you? These are the questions you have to ask yourself. Are you looking to get married anytime soon? Are you looking to have kids anytime soon? Do you think you can upskill your job? Are you retiring soon? Do you foresee career growth and projection? So these are the questions you need to ask yourself to factor them into your investment goal and your investment profile. So when you're able to know all these things, you have to make sure that the investment platform that you've chosen aligns with all these goals and every single thing that you've said that you want for yourself. It's very important for you to note that you might have different goals, which is all right. And you can also use different investment platforms to achieve these different goals. You do not have to use one platform to achieve your goals. In fact, I am always of the opinion that when it comes to diversification, because when it comes to investing, you have to diversify your investment. I always say that diversify across asset management firms and investment platforms to maximize and get the best value from your investments and your money. Now, so we've said number 1 is getting financial education. Number 2 is budgeting and tracking your expenses. Number 3 is choosing a financial firm. Number 4 is creating an investment goal and knowing your investment profile. Number 5 is investing. So when you've chosen your investment profile, you've chosen an investment firm, then you have a wide array of investment options that you can choose from, right? So this could include stocks, bonds, corporate bonds, saving bonds. It could include money market funds, mutual funds, index funds, ETFs, commodities, equity investing. So there are a wide array of options for you to choose from. Now you get to pick based on your risk profile. If you're a high risk investor, if you're a medium risk investor, if you're a low risk investor, you get to choose based on your risk profile. What type of investment, can you do? What type of investment can you dabble into? Okay, let's say you want to have a little bit of every investment option. Then you have to allocate your income according to your risk profile. Let's say, for example, you're a low to medium risk investor and you want to invest in everything. Then I'll probably say, okay, you need to allocate at least 70% of your investment into a very safe investment instrument, like a fixed income investment, like a bond or a high yield savings account. Then you allocate remaining 30% between stock investing, equity investing, commodity investing, forex investing, whatever, crypto investing. So that way you have a balanced profile. So you could do 70 to 80% towards the safer investment instrument and put 30 to 20% towards the medium to high risk investment instruments. That way you have a balanced profile and a balanced, portfolio. But if you want to invest in stock, let's say you want to put all your money in the stock market, you've heard so much about the stock market because stock investing seems to be the rave of the moment, and you want to invest in the stock market as a beginner investor, then I would also suggest the same allocation where you put 70 to 80% of your income into index funds and ETFs, to maximize your risk, and then put the remaining 20-30% into individual stocks. Now, why index funds and ETFs, you might ask? Very simple. When you invest in index funds and ETFs, you're spreading your risk across various companies, across various industries and asset classes, as opposed to when you buy a singular stock of a singular company in a singular industry, like let's say a tech stock. So when you invest in ETFs, you're buying, let's say for example, you invest in the S&P 500. This S&P 500 tracks the top 500 companies in the US. So what that means is you're a part owner, you own all these shares, all these 500 companies in one basket. Like a basket of fruit. When a basket of fruit is about to spoil, let's say you have a basket of fruit of oranges, pineapple, watermelon, they do not all go spoiled at the same time, So it's like a seesaw when you have this basket of different companies. Let's say, for example, Tesla is not doing well, Apple is not doing well. But because you have companies like O Realty, Simon Property Group, all those real estate investment companies, and they're doing well, they help balance your portfolio and cushion the loss from the other top growth tech stocks. I don't know if you see what I'm saying. So that is what ETFs and index funds just for you. Now, guys, so these are the 5 steps for you to start investing as a beginner investor. Number 1 is get financial education, acquire financial literacy. Number 2 is track your expenses and budget your income. Number 3 is choose a financial platform or an asset management firm, a platform where you're going to invest your income. Number 4 is create an investment plan, an investment profile, to understand your risk profile and all. Then number 5 is fund your account and start investing. Invest according to your risk profile. If you're a low to medium risk investor, I've given you a scenario of how you're going to invest your income. If it were me and I want to invest now, let's say, for example, £10,000, I am usually a medium to high risk investor. So I'll probably put 60% of that income into the stock market and, allocate the remaining 40% to, mutual funds, Euro bonds, and high yield savings accounts. So until the next video, guys, thank you for watching. Don't forget to like, subscribe, and share this video with your friends. Let me know if you have any questions in the comment section. And until I see you next time, bye.